Hi, welcome everybody. Sorry for the bit of a late start. We'll let everybody trickle in for a moment here and then get going. You're here in the Low-Income Housing Tax Credit Fundamentals Learning Lab. All right, it looks like folks aren't trickling in just now. We have a lot of material to cover, so I'll get started with introductions. Thanks everybody, thanks for joining us. It's good to be here today, and thank you to Housing California for having us here to walk you through some LIHTC fundamentals for the afternoon. I'll just acknowledge, still being in this world of virtual or semi-virtual conferences, it's still tough. And I wish I was in a room with all of you right now in Sacramento rather than here, but appreciate having the ability to bring all this to you today. So I'm Sharon Bennett. I am the Associate Director of Housing Finance Training at the California Housing Partnership. With me today are my colleagues, Janice Choi and Chad Horsford. They're with me based out of the LA office as housing finance consultants. And we're also fortunate to have with us today Anthony Zito, the Deputy Director of the California Tax Credit Allocation Committee, or TCAC, which you'll be hearing a lot about today. So a bit about the partnership. We were incorporated in 1988. We're a state chartered nonprofit, and our mission is to create and preserve affordable and sustainable homes for Californians with low incomes. And we do that by providing expert financial and policy solutions to nonprofit and public partners. You can check out our website, check us out on Twitter. And if you haven't been to our website lately, we can go to the next slide. We have some great data and research and mapping tools there. Our research and policy team is always busy publishing reports about the need for housing in this state. And there's some really interesting mapping tools that have been developed. So take a look. So let's see, do we have? Here we go. All right. Just to start off, we'd like to get a sense of who's in the virtual room with us today. So if you could take a moment. Great. And Chad just put in the chat a link to a Dropbox folder that has all of the materials that you'll need for today. So that has a PDF of the slides. It has, we're doing 2 exercises in breakout rooms today, and it has the materials that you'll need to go there. So please go to that link and get everything ready. All right. Okay, I'll end this poll here. So we have about an even mix of developers and public agency folks, as well as others. So welcome everyone. And mostly beginner folks as far as comfort level with the low-income housing tax credit. So that you're in the right place. All right. Hopefully after this this seminar, you're a little bit more than beginner. Maybe you'll consider yourself intermediate. All right. So what are we covering today? I'm going to start off with just the basics of the tax credit program, and then Chad will talk about what is a tax credit and the federal and state eligibility and affordability guidelines of the low-income housing tax credit program. Then Janice will talk us through calculating the credit and the amount of equity that you can get to a project. We'll take a 10-minute break, and just a little heads up, during that break, we're going to ask everybody to get out of this webinar room and get into a meeting room so we can have our full breakout room functionality. So just a heads up that there will be some switching around of links and logins at that point in time. When we come back from the break, we'll do an exercise applying the skills that we will have just covered about calculating the credit. And then we'll do a little deeper dive into the difference of the types of credits. We'll talk about 9% versus 4%, as well as the California state tax credit. Talk a little bit about the limited partnership ownership structure and responsibilities. Take another break there before Anthony steps in and does a deep dive into the TCAC threshold requirements, application requirements, their underwriting standards, and then also talking about the 9% point allocation system, as well as scoring and tiebreaker there. We'll have another exercise at that time where you can spot all of the wrong aspects, all of the errors in a pretend 9% pro forma and application. And then we'll close up by briefly talking about TCAC fees and typical project timeline. So just some ground rules and norms here. Please do mute yourself and your distractions. I know it's really tempting to try to keep doing some email on the side or whatever, but it's really best if you just have it all shut down. I know I have all of my stuff shut down here. For Q&A, we will we encourage questions, and we will try to pause for out loud questions as we can. But in the meantime, please type your questions in the chat box, and we'll answer questions that way as we go. Okay. When we do get to the exercises, it's great if people collaborate, if you can pretend that you're sitting next to somebody in a room in Sacramento and, you know, comparing notes over shoulders, that's great. And if you can change your Zoom name to your name and your organization and your pronouns if you'd like, I appreciate that. All right, I already mentioned the link to the PDF of the slides as well as the exercise materials. And Chad is also going to try to upload documents directly to the chat here. And then a big caveat sort of overarching this whole presentation, or if you're watching this recording at a later date, always review the current program regulations and calendars. We cannot possibly cover all of the details in this presentation, and regulations are always changing. So stuff that we're saying here might be inaccurate months from now. So just always double check. All right, before I get going, Anthony, did you want to say hello, introduce yourself?
Yes. Hi, this is Anthony Zito, Deputy Director at TCAC. Yeah, this is not the first time that I've participated in this session. It's been a few years, I think, since I've last done it, but I hope everybody finds this useful, and you know, CHPC always does a great job with this presentation. So, and I like the interactiveness with the exercises. So don't worry, you know, it's okay if we don't get the right answers, but we're just trying to test everyone's knowledge, and I'm happy to be here. And thank you, Housing California. Thank you, CHP, for inviting me.
Great, thanks, Anthony. All right, so the basics. Where did this program come from? Well, it started with the Tax Reform Act of 1986. That's right, it came about during the Reagan administration. And it's because of these bipartisan roots that it's become, you know, one of the longest standing and most successful vehicles for funding affordable housing in this country. So that Tax Reform Act, it included tax incentives for affordable housing, and the major incentive was what we call the LIHTC, the Low Income Housing Tax Credit. And how this works is the Internal Revenue Service allocates 9% tax credits 2 states according to a per capita formula. So actually each state gets the greater of just under 3 million in tax credits or this per capita calculation. Back in 2018, the amount of 9% credits was increased by 12.5% through 2021. That expired. We're hoping that an extension that is currently undergoing budget reconciliation will happen. But for 2022, we fell back to the 2018 per capita amounts. So right now we're at $2.60 per capita for the 9% program, just over 102 million in annual federal credits for the state of California. Every year, TCAC publishes credit estimates on their website that updates these numbers. So you should always check there to see how many 9% credits there are and what buckets they are going to. So once the IRS apportions these to the states, it's then up to the state allocating agencies to figure out how to get those to developers in order to fund their projects. And TCAC is California's allocating agency. So throughout our presentation, we'll use the official acronym CTCAC, but you'll also see it just as TCAC, call it TCAC. And the vehicle for doing this is through the Qualified Allocation Plan. So if anybody talks about the TCAC regs, TCAC regulations, that is the state of California's Qualified Allocation Plan, or QAP. And each state has a different QAP, and they often then comprise state policy objectives in how they are going to send out the 9% tax credits and how they're going to allocate them to various projects. So in addition to allocating the credits, TCAC then also monitors compliance with federal and state requirements. And the federal requirements, that's all in the Internal Revenue Code, Section 42. So if you hear Section 42 thrown around, that's why we're here. And that compliance federally, it's an initial 15-year compliance period, and then an additional 15-year extended use period. So once a developer receives these credits, they then sell them to investors, and investors are able to use the credits to offset federal taxes that are otherwise owed. They do this annually each year for a period of 10 years. Janice will get into that a little bit more on how that actually works. But investors pay money for these credits to offset their taxes, and that cash is then used to help round out the financing stack for the development. So an affordable housing development, it might have a regular bank loan, like a mortgage that it supports through rents. And then it will have other public agency loans, soft funding sources. And then this tax credit equity is sort of the last big chunk to help cover the total development costs. So this whole program, like I said, it had bipartisan roots. It's a public-private partnership. It's using the tax code to drive public policy, leveraging the market needs of investors for the public good. That also means it's all very complicated, right? And is a sort of roundabout way to get to our ultimate goal of funding and building affordable housing. But because this is a federal, tax expenditure, the federal government is not receiving taxes from corporations that purchase these low-income tax credits. That's why there are certain requirements around it, because they're not just going to let you, not pay taxes for no reason. So all of these requirements around it, that all lives in Section 42 of the Internal Revenue Code, and there are federal eligibility guidelines. Now, The amount of credits that each project generates, it varies. It depends on a lot of factors, including the cost of your project, the proportion of eligible units, low-income units that are in the building, the proportion of the project that's used for affordable housing. And we'll get into this a bit more, but basically it's the eligible basis costs that help generate the tax credits. And the equity from low-income housing tax credits can provide up to 70% of the total development costs, but it's usually less than that for a variety of reasons. Once these developments are built, they are owned by a limited partnership, at least in California, that's how it works. And the limited partnership is made up of the developer sponsor general partner, and then the investor limited partner. And the investor receives the tax credits for a 10-year period. That's the tax credit delivery period. And the investor typically owns the development as part of the ownership structure for the 15-year initial compliance period. And they're in there for the full 15 years because if the property falls out of compliance, the tax credits are subject to recapture. And no investor wants that to happen. They don't want to have to pay taxes that they haven't been all along, right? Occasionally an investor might leave early, but if they do leave early, they need to have a lot of assurances in place that compliance will continue through the first 15 years. So I just want to briefly talk about the timeline of a project. I know our friends over in the Introduction to Affordable Housing and Development Learning Lab are talking about this a bit more, but this is just to help everybody situate like when in a project's life cycle are we talking about. So if you're sitting in a developer seat, typically you have a period of pre-development where you are securing your site, you're determining what sort of project you're going to build, you're doing design, you're securing other soft funding, determining your tenant targeting, all of that. After you have all of your other soft funding lined up, and you know that it's going to work out with a conventional lender for construction and perm debt as well, then you apply for your low-income housing tax credit allocation, and hopefully you receive it. And if you do, then you can move towards closing on your construction financing, right? Once that happens, you do the building of your new construction or your rehab of an acquisition rehabilitation project. Once all the work is complete and you're ready to move tenants in, that moment, you receive your temporary or permanent certificate of occupancy. That's when the project places in service. We'll be talking later in the presentation about this place in service time, but I just want to sort of situate when that happens. So you place in service, you then lease up and reach stabilized operations. So you have the tenant rents paying for the operating expenses. Typically, you'll need 3 months of stabilized operations before you can convert to permanent financing. And at that time, a big chunk of your federal tax credit equity comes in to pay off the construction financing. And then you're off in operations for the life of the building. So it's all about operations and compliance monitoring from there. There are 2 types of federal credits. There are 9% credits and 4% credits. So 9% credits, those are the ones that we've talked about being allocated per capita to the states by the IRS. And then TCAC is the allocating agency. And because demand for 9% credits outstrips their supply, the process of applying for 9% credits in California is a competitive one. It's also competitive in a few other states as well. For the 4% credits, those are a non-competitive credit. You can get those as long as you have an allocation of tax-exempt bonds. Tax-exempt bonds are allocated per capita to states, and CDLAC, the California Debt Limit Allocation Committee, is the allocating agency for California as far as tax-exempt bonds. And in the past couple of years, now we've had demand for tax-exempt bonds outstrip their supply. So tax-exempt bonds are a competitive resource now in California. But as long as you get your tax-exempt bond allocation from CDLAC and you meet certain threshold requirements from TCAC, you'll get your 4% credits along with that. And there are also state tax credits for California that we'll talk about later. All right, so I'm going to hand it off to Chad now, who's going to talk about what is a credit.
Thanks, Sharon. I'll build off of some of what Sharon shared earlier and go through tax credits and tax deductions. When an investor purchases ownership interest in a partnership, what they're looking at are not only tax credits, but also taxable benefits. Part of it comes through tax deductions. So to start with tax credits, which we talk about a lot, what is a tax credit? Oftentimes when we're looking at corporations or partnerships, what we hear of in the affordable housing arena are low-income housing tax credits, new market tax credits, PV tax credits. But a lot of us are also familiar with tax credits just in our day-to-day life. So think about when you're filling out your taxes, whether you qualify for the earned income tax credit, whether you get child care tax credits or higher education tax credits, the list goes on and on. All in all, at the end of the day, a tax credit is just a dollar for dollar reduction of taxes owed. So if you owe the government $150 and you have a $50 tax credit, the tax credit directly reduces or offsets how much you would have to pay in taxes to the government. A tax deduction, on the other hand, is a reduction in your taxable income. And some examples of this, we're going to focus more so on the corporation side, but think about mortgage interest, real estate taxes. In your personal life, if you own a house, you may write off interest that you pay on your mortgage as well. But the reduction in taxable income is very different from an offset in taxes that you pay. We'll go through an example in the next few slides that I think will help to clarify this in more detail and put actual numbers to what the impact and the difference in impact between a tax credit and a tax deduction is. So first off, we're going to start off with an example where, let's say the organization that you work for is a for-profit corporation and it's taking in $1 million in gross income. Of the $1 million in gross income, there are no deductions applied, and therefore, let's assume you're subject to the highest corporate tax rate, which currently is 21%. So at the end of the day, you're stuck paying $210,000 in terms of your tax liability, and there's no adjustments to that. So you take in $1 million in income and you have to pay $210,000 in taxes. First, we'll walk through what a tax deduction will do to that. So in the second scenario, in the middle that we're looking at now, you're still taking in the same $1 million in gross income, but we're assuming that there's a $200,000 tax deduction. What the tax deduction does is that it decreases your taxable income by that amount. So $1 million in income, we subtract the $200,000 and the tax deduction, and now your taxable income is $800,000. And that's the base on which your taxes are going to be calculated. So rather than on the left-hand side where you're paying 21% tax rate based on $1 million, your taxable income has been decreased in order to account for the tax deduction. And you're only paying a 21% tax rate on $800,000 in taxable income. So your tax liability, the amount that you'd have to pay in taxes, is now $168,000. And I know some of you are thinking, okay, $42,000 saved. That's pretty good. I feel like an infomercial, but it gets better. If we're looking at a scenario with tax credits now, you start off with the same $1 million in gross income. And unlike the deduction, there's no adjustments on the front end. Off of that $1 million, you're still subject to a 21% tax rate, and you have a tax liability of $210,000. But where the tax credit does come in and how it differs from the tax deduction is the tax credit works by saying, rather than paying $200,000 in taxes, you get this credit which offsets your tax liability. So in lieu of paying taxes, you get this tax credit. And at the end of the day, your tax liability is decreased by the tax credit, and you just have the remaining $10,000 to pay in taxes to the government in this example. So when your investors purchase tax credits from you, what they're doing is they're purchasing these tax credits in lieu of paying taxes. And for a lot of corporate entities, a lot of big banks and financial institutions, the other reason they do so is due to Community Reinvestment Act commitments and obligations. So we're going to launch a quick poll to see how effective that last slide was. And what do you think is more valuable to a taxpayer? Is it $100 in tax credits, $100 in tax deductions, or are they both worth the same amount? And I'll just give 30 seconds for results to come in. It seems like we've hit a critical mass. And most of you are on the same page. And if someone were to walk up to you today and offer you $100 in tax credits, you'd take it and run to the bank because $100 in tax credits, every dollar in tax credits is worth a dollar that you're not paying in taxes, whereas the deductions are worth less. Next slide. So let's go to the next slide. And we'll be walking through eligibility and affordability for the low-income housing tax credit program. So let's start with what do LIHTC projects fund? One is that they're funding developments that are non-transient rental housing. For a lot of us, we think of apartment buildings where you're moving into a rental complex and the purpose is to be there long-term. It's not transitional housing where maybe you have to be out in 30 days or 60 days, but just a long-term place. For the population that the low-income housing tax credit program is serving, overall, it's looking at folks who have incomes of 60% AMI or less. There's a little wrinkle where if you were to pursue something called income averaging, you can serve tenants up to 80% AMI, but by and large, a lot of developments are geared toward folks who earn 60% AMI or less. And then in terms of the forms of buildings, new construction, substantial rehab, which is taking existing buildings and then whether it's bringing out to code or buildings that have been around for a while and putting in. energy efficiency or accessibility improvements and just making it more habitable, and then also acquisition rehab opportunities. So looking at the page that we just went through, some ineligible project types that won't meet this requirement that I know in certain jurisdictions, some of these do come up as people trying to figure out whether they can use tax credits with them. So owner-occupied buildings, for example, that's very, very hard to work it, and that's basically impossible to work with the LIHTC program. So if you think about home ownership, if you think about employer-provided housing or nursing homes, there are other funding sources out there that can be used for those. The LIHTC program just unfortunately isn't one of those. So when we look at the affordability requirements for long-term housing tax credit programs, all developments have to choose one of these set-asides, and these set-asides are set out in the federal guidelines. So you can elect to set aside 20% of the units within the whole development. So if you have a 100-unit development, 20 units at 50% AMI. The second election you can choose to do is to have 40% of units at 60% AMI. And then for projects that elect to do income averaging in order to serve tenants above 60% AMI, but at or below 80% AMI, then you can still elect to have 40% of units at an average of 60% area median income, and just that the income increments for units in that development has to be in 10% increments. And on the next couple slides, we'll walk through what area median income is, how rents are calculated off of it, and dive into a little more detail. But income and rents are set by HUD, and equally important and useful is a lot of the income and rent hurdles you can also find on the TCAC website on the application slide, and that's on the application tab, and that's probably the easiest way to access them. So for 9% projects in California, TCAC has points tied to affordability. And for most project types in most locations, at least you need to score maximum points or pretty near maximum points. And that will force you to set units largely at 40, 45, 50% AMI, where in order to score maximum points under the affordability section, on average, you need to target around 45% AMI on a project level. So if you have very low income units at 30% AMI, you can balance them out with 60% AMI or 50% AMI units. But your project level affordability, you're probably targeting around 45% AMI. And for all 9% projects, at least 10% of units have to be at 30% AMI, and that requirement has to be met on a per unit size requirement. So you start off with your larger unit sizes. For example, if you have 3, 2, and 1 bedroom units, you start off at the 3 bedroom units and ensure that 10% of your 3 bedroom units are at 30% AMI, go down to your 2 bedroom units and do the same, and then go down to your 1 bedroom units and do the same. And sometimes there can be slight discrepancies where you meet the 10% on a project level prior to exhausting, to going down to the smallest units. And in those cases, as long as you start from the largest units and work down, you're okay. For 4% projects, on the tax credit side, you have to average 60% AMI or less. And on the SIDLAC side, you have to have at least 10% of units at or below 50% AMI. And again, a lot of this is baked into scoring. And as you work through the applications on the TCAC and the SIDLAC side, we really do recommend that you look at the scoring, and the scoring is going to push you in the right direction. the federal guidelines set compliance periods, and then through the qualified allocation plans, the state can also set their own compliance periods for affordability. So on the federal side, there's a 15-year initial compliance period and then 30-year extended compliance period. But since we're at Housing California and talking about California Affordable Housing Development, you're really going to be subject to the state of California requirements, which are 55 years for both 9% competitive credits as well as 4% non-competitive credits. So before, when I was talking about area median income, when we're looking at rent setting for LIHTC development, rents are set at 30% of area median income. The median income in a geography, we're talking about the person exactly in the middle. It's not taking the average, but just seeing what that person in the middle of the population, what they make. And for LIHTC developments, we're largely talking about targeting units to 60% of area median income. So 60% of what that middle person makes or less. And then, for example, for 60% area median income rents, and just rents in general, the rents are set at 30% of what that median income is. So a quick calculation is just to take the median income, divide it by 12, and then look at what 30% of that amount is to come up with a monthly rent. And monthly rents for the tax credit program, they incorporate a utility allowance, which is usually published by the local housing authority, or in some cases, a developer may also choose to use the California Utility Allowance Calculator, or QX, to come up with the utility allowance. And the 30% rent ceiling is set by looking at the rent the tenant pays plus the utility allowance, and only cannot exceed that 30%. So you can look at the gross rent, deduct the utility allowance, and then that will give you the net rent, which is what a tenant would actually pay. And then I'll pass it off to Janice for calculating tax credits.
Thanks, Chad. So because we started a little bit late, I'm going to try to make up a little bit of time here. The good news is that even if I go a little quickly through this calculation, we're going to practice putting it into action during our exercise after the break. So you'll have plenty of time to sort of dig in and get your bearings. So how do we calculate the credit? It all starts with eligible basis, which is essentially the cost of acquiring, rehabilitating, and constructing a building. Often you will see it match up with depreciable basis, and that's defined in tax code what that is. But basically, it's imagine if you build your building and it burns down the next day. What are the costs that you would incur to rebuild it? So that includes things like hiring your architect to redesign, engineers, and of course the actual construction costs. What it does not include are things like land, because you already have it. And then it also excludes things like your permanent financing costs, any reserves like operating or replacement reserves, any capitalized reserves. And then your syndication expenses, such as legal fees associated with your tax credit syndication, or any consulting fees associated with the tax credit syndication, and marketing costs. So things that that are associated with once after the building is already built and is in operation. So those costs do not get included in eligible basis. Folks like us at CHBC, your financial consultant, can help you determine what is included in eligible basis, what is not. But also, of course, your CPA or your accountant and your tax attorney will be your best resources. So here's an example. You have a development budget that includes $1 million of land acquisition, $4 million of hard costs, $1 million of soft costs like architecture, engineering, those sorts of things, and then $400,000 in syndication costs and reserves. Your total development cost, add all those things up, 6.4 million. But the only things that get included in eligibility basis are your hard costs and your soft costs. Again, remember, land acquisition not included, syndication costs and reserves not included. So your total eligible basis in this case is 5 million. Now, here's the full calculation for what you would get in investor equity based on your eligible basis. You can see there are many steps, and we're going to walk through it one by one. So first, you want to ask yourself, is your project located in a small area, difficult to develop area, or in a QCT, a qualified census tract? A qualified census tract is essentially a census tract that has 25% or more poverty rate, or is, I think it's 50% of households at or below 60% AMI. And then a difficult to develop area is a census tract that is located in an area that has higher costs to build and higher utility costs, those sorts of things in comparison to area median income. Now, there's a map that you can go to. The link is right here. That'll show you if your project is in one of these areas. And if you are, then you can increase your basis, your eligible basis by 30%. Actually, that gets you to your adjusted eligible basis. And you can see here examples of what the map looks like. The sort of brown reddish areas are the SADDAs, and the QCTs are notated with the purple. Okay, so you get that 30% boost if you're in a DDA or QCT. And in this case, we're assuming that you are in one of those locations. And your adjusted eligible basis then becomes 6.5 million. Okay, so next we look at your applicable fraction, which is essentially how much of your project is attributable to eligible units, low-income units, as opposed to non-low-income units. Now, there are two ways to calculate this, and you're going to end up taking the lesser of. So first, you look at your ratio of low-income units to all residential rental units in your property. That gets you one number. In this case, in this example, if you have 50 low-income units out of 75, then your applicable fraction would be 66.7%. The other way to calculate it is based on your floor area. So again, in this example, we're looking at 30,000 square feet of low-income units, attributable to low-income units, and then out of 50,000 square feet of total residential floor space, your applicable fraction in that case is 60%. So again, you take the lesser of the two, your applicable fraction here is 60%. Okay. Once you apply that applicable fraction to your adjusted eligible basis, you get your qualified basis, which is the portion of your building's eligible basis that is attributable to your low-income tenants. Usually, most of the projects that we work on, 100% of the units are low-income units. And so we're going to assume that here, that your applicable fraction is 100%. And so your qualified basis is the same 6.5% that we saw above in the adjusted eligible basis. Okay. Next, you have your tax credit rates. So as you've been hearing earlier, there are two different types. There's 9% and 4% tax credits. And before, you would have to check this link here for monthly published federal rates because they would move. But in 2016, the 9% tax credit rate was locked at 9%. And in 2021, the 4% tax credit rate was locked at 4%. So now we don't have to look at those monthly posts so much anymore, unless you have a project that closed before these rate locks happened, in which case you still might have a floating rate to keep track of. But in any case, we're going to assume that we're talking about a current project that has these fixed rates. And by applying either the 9 or 4% rate to your qualified basis, you wind up with your annual tax credit amount. And that's the amount that you get in 1 year. Okay. So we're assuming here that we're looking at a 9% project. We're applying a 9% tax credit rate to the 6.5 million qualified basis. And we end up with 585,000 in annual tax credits. Now you multiply that by 10 years because you get your credits delivered over a 10-year period. So multiply by 10, get 5.85 million in total tax credits. You then take this and you market it to investors and see what they're willing to pay. So often you'll see this expressed as cents per dollar. In this case, we're saying that the investor is willing to pay 95 cents per every dollar of tax credit. And that's every tax credit that's delivered over the 10 years. So you take your full 10 years of credits, multiply by that 0.95 amount. I think I missed my slide. Anyway, and then that gets you your total equity that then goes to pay for your project costs. Things that affect equity or tax credit pricing. So your investor is going to look at what their internal rate of return is. And you have to remember that when they're looking at, when they're putting in their equity and when they're getting the credits, it's whatever credits they get earlier is going to be worth more to them than what they get later due to the time value of money. And same for when they pay in their equity installments. The later that they get to pay in their installments, the better it is for them. And so they look at the timing of these things, and also they look at what they're getting over the 15 years that they're part of the partnership in tax benefits, which include not just the credits, but also tax losses that result from things like depreciation, tax deductions, things like that, or interest deductions, those sorts of things that Chad briefly touched on. So other things that investors are looking at, again, Chad mentioned the Community Reinvestment Act. So investors who, they can, by investing in tax credit projects, they can help meet their CRA obligations. And so if your project is located in a CRA area, they might want to invest in yours more and thus pay more per dollar credit. It also depends on where your project is located in general. That might have an impact on what investors is wanting to pay, how badly they want your project in that location. And also their relationship with you as a developer can matter a lot. And what kind of project you're building. Some investors might be looking specifically for new construction versus rehabs, for example, and also risk. Obviously, if your project poses less risk to the investor, they would be hungrier for your project and pay more. Okay. Okay, so I'm going to post this poll. And this sort of covers something that was covered earlier in Chad's section, but then also the second question is applicable to what we just talked about in calculating your tax credit equity. So, oops. Sorry, my cursor just disappeared. Okay. Oh no. Hey Sharon, do you mind running this poll? For some reason, my cursor just went away and I can't see where it is.
I gotcha.
Thanks. Okay, so credits are normally delivered over how many years? And the initial compliance period is how many years? Again, this is something that Chad covered earlier in his section. And the second question is, true or false, eligible basis and qualified basis are the same thing. I think we'll keep this open probably for another 30 seconds or so. Okay, looks like responses are slowing down. Okay. So, yes, it looks like most of you guys have that first question correct. So credits are typically delivered over 10 years. That's why in the calculation, we multiply the 1 year annual credits by 10. And then, yes, the initial compliance period is 15 years. That's the amount of time that the investor is typically remains a part of the limited partnership that owns the property, because they want to make sure that that compliance period is, that during those 15 years, compliance is maintained. And then it looks like there weren't too many, yeah, there we go. So it looks like everybody pretty much got the second question as well. Eligible basis is not the same as qualified basis. The qualified basis takes into account whether or not you're in a QCT or DDA, and also what your applicable fraction is. Okay. All right, great. So there we go. Okay, my cursor is returned. So again, there are things that affect the amount of tax credits that you receive. We just talked about things that affect tax credit pricing by the investor, but here we're taking a step back and looking at the actual amount of tax credits that you can offer an investor. We talked about some of these things, like whether you're in a QCT or a DDA, and what your baseline eligible basis is based on your project costs. And then of course, percent of units that are credit eligible, and how many of those units are being used for affordable housing. The one thing that we didn't talk about is other types of tax credits that can affect your low-income housing tax credit amount. These include your energy and historic tax credits. Essentially, the IRS doesn't want you double dipping. So they'll decrease the amount of your low-income housing tax credits based on whether or not you're claiming these other credits. Okay. Some things that are specific to California. Obviously, the purchaser of the credits will have to have California state tax liabilities, and also, of course, you have to be eligible. The project has to be eligible for the California state tax credit. For both 4% and 9% projects, there are benefits to reducing your basis. It results in a more competitive application. On the 4% side, it's not actually the 4% application that becomes more competitive. It's the bond application associated with the 4% credits. But in case there are times when you might want to reduce voluntarily your basis. And for 9% competitive applications, there is a $2.5 million annual credit cap for each project. So even if you are eligible based on your basis calculation for more than 2.5 million per year, you'll be capped at that amount. That's just how the 9% credit program works. And then here's this big one at the end here, threshold basis limits. So TCAC, they have implemented threshold basis limits as a way of controlling costs and for limiting credit allocation since they are so competitive. It basically, it takes cost data from past projects and adjusts for where the project is located in the state and the number of bedrooms or the unit sizes. And it publishes every year what the cap is going to be in eligible basis for each unit type in each geographic location. Before 2021, there were different basis limits for 4% and 9% credits, but now they are the same. And here's an example.
I'll just say that every year when TCAC publishes their threshold basis limits, they include a little memo that goes into more detail on the methodology behind it. So if you're methodology nerds out there, you can read about it on TCAC's website.
Yes. Yeah, and here's an example of what that looks like. You can see that it specifies by unit size what the threshold basis limit is, and then calculates based on the number of units at each of those sizes what the total threshold basis limit is for your project. Okay. And threshold basis limit, so in addition to that calculation that we just saw, there are adjustments that can be made to account for things that that result in higher costs, like paying prevailing wage or having to build structured parking or providing elevator service for 95% or more units on upper levels. And type 1 or type 3 construction. There are different percentages that threshold basis limits can be increased based on each of these things, and those are outlined in both the TCAC regs and in the application itself. Local development impact fees are another thing that that get accounted for, or the inclusion of daycare facilities or 100% special needs projects. The boosts are also available for some other things that advance state policy goals, like costs associated with making your building extra energy efficient, for example, or mitigating environmental or seismic issues that your property might have. And also, if your project is located in a high or highest resourced area, according to this map, you can see the link in the upper right-hand corner. And you have to meet some other requirements. But if you're located in one of those areas, then you're also eligible for a boost to your threshold basis limit. For 4% projects only, you also get boosts for every unit that is below 30% AMI, or sorry, my notes are a little squished, or are I believe below 50%. Sorry, I have to double check that. Don't quote me on that. Chat, if you can double check and put that in the chat. And here's what that looks like in the application. It's really tiny. I know it's really hard to read, but you can just download this from the TCAC website. You can see for yourself in the application. There's this whole calculation of what boost you're eligible for based on these yes or no's. Okay, so just to check, the purpose of TCAC's threshold basis limits are, oops, sorry, this is the wrong slide. Okay, there we go, launching the poll. Purpose of the threshold basis limits are to limit tax credit requests, to limit eligible basis, to control project costs, or all of the above. Okay, we'll give it about 10 more seconds. Okay. So yes, it's all the above. I just realized that the way that the question's worded sort of gives it away, saying that the purposes are. So yes, the threshold basis limits, they limit credit requests, they limit eligible basis, and they control project costs all in different ways. And you guys got that spot on. Okay. So quickly going through an example of how the threshold basis limit gets applied. So going back to what we had before, we had the $5 million of eligible basis. Let's assume that your threshold basis limit is actually 4.5 million. You have to take the lesser of the two before you go on to compute the rest of this. So the lesser of the two is the threshold basis limit of 4.5 million. Apply the 30% boost for being in a QCT or DDA. And then you assume that the entire property is housing low income residents. That's 100% applicable fraction. And you're applying the 9% credit rate in this case. Multiply your annual tax credit by 10 years. And then we're assuming still that the tax credit factor, the amount the investor is paying per credit, is 95 cents. Your investor equity at the end of the day then is the 5,101,750, which is less than what we had calculated before because we're being limited by that threshold basis limit. Okay. One additional thing to keep in mind is TCAC will only fund projects that meet their high cost test. And their high cost test is their total eligible basis divided by your adjusted threshold basis limit. And that has to be, if that is greater than 130%, then you are considered a high cost project, and they will not fund you for 9% credits. And that's at the time of application. At the time of placed in service, so once your project is completed, you've placed in service, you've received your TCO or CO, then you take your total eligible basis at that time divided by your threshold basis limit at that time. And if that exceeds 140%, then again, you're considered high cost and you're at risk of receiving negative points. This rarely impacts 4% credits or projects with 4% credits because of the affordability boost that those projects receive. That increases their threshold basis limit usually high enough where you don't come even close to meeting it. So typically you only worry about this with 9% applications. And then one last thing before we take a break. You'll have noticed that we threw around this 130% boost a couple times, or this percentage comes up a couple times. And I just want to clarify that the 130% basis boost for projects that are located in a QCT or DDA is not the same as the TCAC 130% high cost test at application. Those are two different things. And also the high cost area map, the map that shows the QCTs and DDAs, that is not the same as the TCAC and HCD opportunity map, which designates which locations are higher or highest opportunity areas. So just keep that in mind. Okay, we're going to take a break.
Hold on.
Okay, it is 2:20. It looks like most people have ported over to the meeting, which is great. Thank you for for the technical difficulties there. Okay, so we're going to do a little exercise to get you practicing calculating tax credits and equity. We have a hypothetical project called Lupine Lane and some information about that project that will give you everything you need to determine what the threshold basis limit is for the development, and also then how much equity you can expect to receive for this project. We're going to break out into groups in a moment, but I wanted to quickly outline sort of how this is going to go. We have an Excel document that you all should be able to open. Is that correct? If anybody has not been able to access the Excel file, please let us know, either in chat or just speaking up. Everybody good? Okay. And so we're going to give you, I think 15 minutes, is that right, Sharon? To go through the exercise in your breakout groups. And you'll be able to fill in the Excel, put in the formulas that you need in order to come up with the final equity result. And Chad, Sharon, and I will be sort of hopping around to the different breakout groups to provide assistance as needed. Sharon, do you want to say anything else about logistics? At the end, sorry, go ahead.
Yeah, just after you read the case, feel free to work together in your groups.
And then at the end of the 15 minutes, we're going to come back together as one large group and go over the answers.
That's right.
Okay. Okay. So how are we doing the breakout rooms?
This is Martin. I will just go ahead and launch them.
Great, thank you.
Here we go.
Okay, do we have everybody back? I think this looks like critical mass.
Hold on, it looks like room 3 folks are still talking in their room. They'll be back in 10 seconds. All right, I think we're here.
Okay. Okay. So I know that was not enough time. That was not enough time, and it was a little chaotic switching rooms and breaking out into, anyway, it was a little crazy, a little less smooth than we would have liked, but let's go through the answers. Okay, so the first task was to figure out what the threshold basis limit was for this project. I know there is some confusion about which boosts applied, but I would say that you can assume that the boosts, unless they're specifically mentioned in the scenario paragraph, you can assume that the boost does not apply. So the things that are called out in the scenario are the prevailing wages and the parking, the elevator service, and local development impact fees, which you can find on the second tab. In the development budget, it specified what the local development impact fee amount was. So totaling all of that up, you wind up with an adjusted threshold basis limit of $20,580,000. Okay. Any questions about that? Okay, if something comes to mind, feel free to type into the chat. Okay, and the second piece is determining the eligible basis. Remember here, land and any sort of perm period costs and operating reserve syndication costs, those do not count towards eligible basis. So what you have left are the construction costs, permits and fees, local development impact fees, architecture, engineering, construction loan fees and interest, and developer fee. Those things told together make result in a total eligible basis of $22,200,000. And the very last piece of this exercise was about calculating the credits and equity. So we have the $22,200,000 eligible basis that we just calculated above. But then we have an adjusted threshold basis limit of only $20,580,000. So you take the lesser of the two and apply the rest of the calculations to that number. So taking the threshold basis limit amount and applying the 30% DDA QCT adjustment, you arrive at your adjusted eligible basis number of roughly 27 million. Apply the applicable fraction of 100% because all of your units are low-income units. So your qualified basis stays the same as your adjusted eligible basis. Apply that a 9% rate to that number, get your annual tax credits multiplied by 10. You end up with 24 and change million of tax credits over 10 years, and then apply a tax credit factor of 95 cents per dollar. And your total estimated tax credit equity is 22,874,670. I don't know that anybody had enough time to get through all of that, but it is a good exercise to go through on your own time if you have a chance. It's yeah, because you're going to be doing that on every project. So, okay.
And we will we'll add that answer sheet to the Dropbox link, and we'll post it up in the chat right now too. Just one thing that came up in the room I was peeking at, there was a question about whether common area was included in the applicable fraction, and if you and the the floor space ratio. So the answer there is the applicable fraction and floor space ratio, that's really only looking at the residential uses. So ratio of low income residential units, proportion of low income residential floor area. So we exclude the manager's units and we exclude the common areas. And if this were a building with, say, a commercial space, those commercial costs would already be excluded from eligible basis from the start. So that's where that is accounted for. Okay. All right. So thanks everybody, and again, thanks for hopping over to this other link with us. Hopefully we'll have smooth sailing from here on out. All right. Okay. So now I'm going to go into a bit more detail about the types of credits, 4% versus 9%, as well as state credits. And again, if there are any questions as we go through this, feel free to post them in the chat. All right, so 9% credits, we've already talked about this a fair amount, and I'll just note throughout this PowerPoint slides, you maybe have noticed this sort of light blue coloring. This is for items that apply only to the 9% program. We try to call them out in this color. Items that apply only to the 4% program, we've tried to note those in orange. Other items that apply to both are not highlighted anyway. So hopefully that's a little bit helpful as you look through this. So the 9%, again, these are the ones allocated per capita. It's a highly competitive process to get a 9% allocation in California. Because you are multiplying by that 9% credit rate, it generates a larger amount of credits and equity compared to the 4% program. Again, California, we have a $2.5 million annual per project cap. So only $2.5 million in annual credits. And then, as we'll learn later, as we walk through the allocation system, you might also be limited to the amount of credits that are available to your geographic region or your specific set aside.
Hey, Sharon, it looks like I'm seeing the screen stuck on the exercise window.
Oh, sorry, let me try to reshare here. Thank you for that. Okay, better. All right. Thanks, folks. So yeah, this is just what I talked about. For the 4% credits, these are what we call, they're non-competitive credits. The competitive aspect is the tax exempt bond allocation from SIDLAC. But as long as you receive that tax exempt bond allocation, you can get 4% credits from TCAC, as long as you meet threshold requirements of the program. So there's no state volume cap on credits. It's only a volume cap on the bonds. But because you're using that 4% credit rate, typically you're generating a lower amount of credits and less equity. However, since there's no $2.5 million annual cap, if depending on what your eligible basis is, you can have more than $2.5 million in annual credits in the 4% program. So 9% and 4%, as we've been talking about, are the credit rates. And when we're talking about applying credit rates to our projects, there are different types of project costs we have to consider. So in a new construction project, we're really only thinking about that eligible basis, which is called new construction or rehab basis. For an acquisition rehab project, you're purchasing a building, and then you're also doing sort of construction work. And so the eligible basis for AC rehab projects are split into two categories. There's the building basis that aligns with the cost of the building. And then there's the rehab basis that aligns with the rehab expenditures. And so sometimes the credit rates are applied differently across these different categories of basis. For new construction, it's pretty easy. You just have the one basis type. It's either 9% all the way down or 4% all the way down. Here I'll just go through. So here again, 9%. Your acquisition eligible basis is not something you have to worry about. You're just applying the 9% credit rate. New construction 4%, same idea. However, if you're doing an AC rehab in the 9% program, you're applying that 9% credit rate to your rehab eligible basis with the 4% credit rate on your acquisition eligible basis. You can only get so many tax credits based on acquiring building. On AC rehab under the 4% program, you will have a 4% credit rate across the board. This chart is also just calling out that in a 4% project, most of your construction debt and your perm debt is going to be tax exempt. That means the interest on it, the interest income to the lender is exempt from taxes. For 9%, you're going to be under just conventional taxable debt. And we used to, there can be an impact to the interest rates that are charged. So your taxable interest rates will be a little bit higher than your tax exempt interest rates. That spread between those two recently has been pretty low since interest rates have been so low, but as interest rates creep up, I think we'll see more and more of a spread between these two. And you can see details about how this plays out with numbers in the appendix slides. So I just want to take this moment to talk about a couple more things to be aware of when using tax credits with an AC rehab project. One of which is the 10-year rule. And the 10-year rule states that no 4% acquisition credits can be generated by acquiring the building if ownership has changed in the past 10 years. Right? Now, there are certain exceptions under this for government purchases, foreclosures, there are certain nonprofit exemptions, but it's complicated. And what that means is before you go off modeling your project and assuming that you can get acquisition credits on it, you have to talk to your tax attorney. And talk to your tax attorney before you do any acquisition activities on a project if you think you need those acquisition credits generated by the eligible basis related to the building in order to make your project pencil. This rule is in place by the federal government basically to put a limit to flipping properties, if we want to think about it that way, right? They don't want investors to just churn properties and put in minimum rehab and be able to get all of these tax goodies. Right? So in addition to this, they want to make sure that you are doing an actual substantial job in the rehab, not just surface cosmetic improvements. So federally, there are these requirements that your rehab related expenditures have to be the greater of per unit amount, which is adjusted annually for inflation, or 20% of your acquisition basis. So 20% of the value of the building. Okay. And the state of California has even stricter requirements than that, right? So from the TCAC point of view, to access 9% credits for an AC rehab, you need to be doing at least $40,000 per unit of hard costs. And then SIDLAC, to get a tax exempt bond allocation for an AC rehab, you have to be doing $60,000 per unit. And that's to qualify in a couple of their AC rehab pools. So you want to be sure that your project budget is including sufficient cost to pass these requirements. All right, so that's about 4%, 9% AC rehabs. Now let's talk about state tax credits. So the state tax credit program started in 2014. Not all states have a state tax credit program, but California does. Originally, it was envisioned as a way to help projects that were ineligible for that 130% DDA or QCT boost, and to particularly help special needs, farm worker, and certain rehab projects. That's the standard tax credit, state tax credit program. The past few years, we've also had what's called the enhanced state tax credits. This has been in the state budget, 500 million worth of state tax credits, only available to 4% new construction projects. State tax credits, there are lots of configurations. TCAC has a good chart on their website, and I'll walk through the basics here pretty quickly. Okay, we could do a whole hour session on state tax credits probably, but to start, so the standard credits, and thinking about it with 9% developments. In order to be eligible for these, you have to either not be located in a DDA or QCT, or you have to forego your DDA or QCT boost, or certain projects can double dip. So if you're 50% special needs, you can get the 130% boost and request state tax credits, regardless of whether you're located in a DDA or QCT. But in order to do this, you have to maximize your federal credit request. And the state credit rates are different from the federal credit rates. So here you get 30% on your construction basis. And annually, we have 70 million per year under the state tax credit program, the standard state tax credits, inflated by CPI, plus a bit of carryover. So every year the amount available will change. And most of this, 85% of this bucket, is set aside for the 9% program. You also have farm worker state tax credits. So if it's a 50% farm worker household, you can access this pool of state tax credits. Now this one, they only have 500,000 per year allocated to this pool. So what you'll see is often years go by without anybody applying for farm worker credits. And then once there are enough available to, provide for feasibility to a project, you'll see projects apply for these. That's on the 9% side. On the 4% only side, again, we have this enhanced state tax credit bucket for 4% new construction projects. Again, this is 500 million per year, and this year we have about almost 519 million available. That's because there were some left over at the end of the year last year. That's the carryover amount. A portion of these are set aside for the mixed income program projects, but anything else just goes to the regular 4% low income new construction. And these also have a 30% credit rate. So there's a portion of those standard state tax credits that are allocated for the 4%. As long as there are these enhanced credits available for new construction, these standard state credits are only available to AC rehab projects in the 4% program. And again, that's the 15% of the standard state tax credit bucket. And then 4% developments also have farm worker state tax credits. What's different here is there's a 75% credit rate used instead of the 30% credit rate on the 9% side. Right. And finally, for 9% or 4%, there is this super valuable state tax credit with a 95% credit rate. But this is for a very small pool of projects. So the eligibility here is you have to meet low appraised value criteria. And what that means is the building basis, the acquisition basis is insufficient to generate credits in order to fund the rehab that needs to be done. Right? And the reason why you are seeing a low appraised value here is that these buildings are at least 15 years old. They have an existing regulatory agreement, and the average AMI, the average income of the residents, is less than or equal to 45%. So because the income of these buildings is so low, that means that their appraised value is low. And it can be really hard to make these deals pencil. So there's this bucket of state tax credits for these. Now, for state tax credit pricing, the investor here must have California state tax liability, because these are credits on your state taxes, not your federal taxes. And a few years ago, there was introduced this option to certificate state credits, which again, that's for state tax credits level 200. But basically, it helps increase the pricing of your state tax credits and makes them a little bit more valuable to the investor. The equity is delivered, per the investor's pay-in schedule. Typically, we would see most of it come in at permanent conversion and a portion held out until you get the tax credit form from the state that says, yes, you have these state tax credits. Okay. And the credits themselves, instead of being delivered over 10 years, like the federal credits, they're delivered over 4 years. And there are some slides in the appendix that cover the math of that. I won't get into that now. All right, so I will pass it off to Janice to talk about ownership.
Okay, so this is a little bit of a departure from what we've been talking about. We want to touch on how these, how the ownership is structured for these projects, because it's very particular. So in California, the owners of these low-income housing tax credit projects are limited partnerships, which is composed of a GP, which is usually the sponsor or an affiliate of the sponsor, and an LP, which is the tax credit investor. I'm going to put up a poll to sort of test your knowledge before we actually go through what the roles of each party is. Okay. So there are several questions to this poll. versus who manages the day-to-day operations, the general partner or the limited partner, who is the nonprofit corporation or nonprofit controlled LLC, who owns 99.9% share of the partnership, who has unlimited liability, who is not usually motivated by project cash flow, and who requires guarantees. Because there are so many questions, we're going to give a little bit of time for you to answer all of them. Okay, there's still a few coming in, but it looks like it's tapering off. We'll give it 5 more seconds. Okay. Okay, so I'm going to go through the next few slides that talk about the actual roles and responsibilities of the GP and LP, and then I'll post the results at the end and see how you guys did, sort of comparing the pretest to what we learned. Okay, so the limited partnership essentially provides equity for the project, but then the tax benefits from the project flow back to the partners. And that's what makes it worthwhile for the investor to put the money in the first place, to purchase the tax credits. They get benefits from the project itself, not just the credits. So it's a two-piece thing. Okay. Next slide. Okay, so the general partner typically holds 0.01% share of the partnership, whereas the limited partner investor holds the bulk, the remaining 99.99%. And that means that they get the bulk of the benefits from the property. The GP, or specifically the managing GP, they manage the day-to-day operations. Sometimes there can be an administrative general partner who has more of a hands-off role, but in joint ventures, sometimes you'll see like two developers or two nonprofits are pairing together in these tax credit projects. One will typically be designated a managing partner and the other one will be administrative. But the LP, the investor, has no direct management oversight. They're really in the partnership for that 99.99% share of the tax benefits. The GP is typically a limited liability corporation, and that's controlled by a nonprofit sponsor, whereas the LP can be either a single corporate investor like a bank, or it can be a multi-investor equity fund. Like you might have heard of a few different syndicators that are out there, like Redstone or NEF, or we'll talk a little bit more about who those can be in a few slides. Okay. The GP holds unlimited liability, except in the case of non-recourse debt, which liability stops with the property. It doesn't, you can't go after the GP for those forms of debt, whereas the LP only has liability related to their equity investment. The GP is the one that's developing the project. The LP does not do any development. And the GP receives fees like their developer fee and a partnership management fee that comes out of cash flow. Whereas the limited partner, they'll get an asset management fee from cash flow, but other than that, and the syndicator, if there is a syndicator, they'll receive some fees, but the big one, the developer fee, that goes to the GP. The GP is the one that's going to care about cash flow and sales proceeds. The LP usually is not motivated by that. There are some exceptions. Lately, we've been seeing more and more investors who kind of want to get everything they can out of the property. So usually, as we were talking about before, most investors will leave the partnership after the 15-year compliance period is over, because they've already gotten the bulk of their the tax benefits and the credits that they were banking on. But there are some investors that will want to try to stay in for a cut of additional benefits. So we always try to advise our clients to not work with those known investors who have done this in the past. Okay, and then the GP is one that provides the guarantees, and the LP is one that requires the guarantees. Next slide, please. Okay, so let me just post the results really quickly. So you guys are actually pretty funny. You already knew a lot of this, so that's great. Yeah, the GP manages day-to-day operations and is typically the nonprofit corporation, nonprofit controlled LLC, and they have unlimited liability. The LP is the one that owns 99.99% share of the partnership and requires the guarantees. The one that seemed to be split was the question of who is not usually motivated by project cash flow. Yeah, so again, usually it's the general partner that does care about cash flow. The limited partner usually does not, but there are a few cases where they agree. Okay. Next slide, please. Okay, so as I mentioned before, some examples of investors that you might see are banks as sort of direct investors, single entity investors, like US Bank, Bank of America, Wells Fargo. That's just a small sample of the banks that do LIHTC investing. And then you have two different types of syndicators. There are nonprofit syndicators like NEF, the National Equity Fund, or Enterprise, Merit Community Capital. Those are very common nonprofit syndicators in California. And then you have for-profit syndicators like Raymond James, Redstone, Hudson, Aegon, Boston Financial, all these. It's important to note, again, that this is not an exhaustive list. There are many more investors and syndicators out there. That's just a small sampling. Okay. So we're going to take another break. And when we come back, we're going to talk about, well, actually, we're going to turn it over to Anthony, I believe, to talk about TCAC underwriting and requirements. But let's come back at 3:24.
Yeah, encourage everybody to stand up, stretch, take your eyes off a screen for a minute, because Anthony's about to throw a lot of detail at you. So thanks. See you in 10 minutes. All right, folks, welcome back. Hope you were able to get a snack. I did. It's a long afternoon, but now we're getting into the meat of the California program, and Anthony Zito, Deputy Director from TCAC, is going to walk us through these next two portions here.
Thank you, Sharon. All right, so we're going to start with the TCAC requirements and underwriting. As mentioned previously, allocations are, the TCAC is the administrator of the low-income housing tax credit program, so we're the ones that allocate the credits and award the credits. The website is on the slide there that you see. Has all of our documents, regulations, memos, everything. So check it out, and as we go through these next slides, it might be, helpful to have the regs out. You're not going to be able to reference them because it's going to go faster than probably that. So, but they are on the slides for your reference in the future. All right, so there's 3 ways to get credits. We have, I know that we went into great detail on the different types of tax credits, 9%, 4%. So as previously mentioned, 9% credits are a competitive application process. We're typically oversubscribed at least 2 to 1. This first round is an anomaly. We didn't have as many applications this first round, but typically it's 2 to 1 oversubscribed. And again, the 9% is on the construction related basis, whereas by federal statute, acquisition is calculated using the 4% factor. And again, the per capita number is based on the population, or the tax credits available in a given year is based on the per capita figure multiplied times the population in California. We had a little over 100 million, and that gets distributed into various set-asides, and then ultimately among the 11 or I think 12 regions that we have. And there's a cascading sort, as we call it, method on how these projects are selected. And then 4% credits, as previously mentioned, non-competitive. And again, the section 10326, that's focused on the bond projects, and the 10325 is focused on the 9% projects. These again have to be paired with tax exempt bonds. So they have to receive a bond allocation from CIDLAC in order to access that 4% tax credit. The 4% tax credit is unlimited to the extent that the bonds are able to be allocated to these projects. So you could request as much 4% credit as you like, provided your basis justifies it. However, if the project doesn't ultimately get bonds, then you can't access the 4% credit. Yeah, so the 4% is on acquisition and construction related basis. And again, you just have to meet the minimum thresholds in order to access those credits. And again, get bonds. Okay, and then 4% plus state. These projects, while they're still, 4% are still non-competitive, they are technically competitive because they are limiting. And again, they have to get tax exempt bonds, so they're bound by the competitive system at CIDLAC. So in order to access these state credits, you have to win at CIDLAC, and therefore you're bound by their competitive scoring system. And these projects again have to be paired with tax exempt bonds, 4% calculation factor, and then we discussed the different calculations on the state tax credits. You can get 13 in those instances for the, as I think Sharon mentioned, the ACT rehab specific ones, and then we got the 30% factor that gets multiplied for the new construction state tax credits. The process has changed dramatically through the years because historically these bonds were not competitive, but with all the influx of the other resources such as these state credits, the bonds are now competitive, and maybe even more so than the 9% credit. I think last year it was 3 to 1 oversubscribed. And so in preparation of that, and I think even through the years, we tried to align with CIDLAC, and in doing so, we created this joint application between the two agencies so that the sponsors would just fill out one application and submit it, and that way it would get reviewed, and we'd have the same figures and everything would be the same. That's what we call the joint application. So we have now adjusted at TCAC and CIDLAC to accept applications in simultaneously in the same rounds to avoid one getting funded one and not the other, and then so forth. So now we have a joint application, and the system basically requires you either get both or you get neither. So that's the 4% credits. The next slide kind of gives you an overall look at the regulations based on sections. Obviously, it's made up of definitions, the system on how we fund the credits. There's a whole section on state tax credits, 103.17. Application requirements, 103.22 is required of all applications. So whether it's 9% or 4%, all of the projects or applications that are received have to submit all of the documents in that section. And then, like these are color coded, as previously mentioned. 103.25 is specific to the 9%, as they call credit ceiling. So you'll see in the regulations, there's a lot of references to credit ceiling, and that's the 9% tax credits. And in 103.25, they outlines the threshold requirements as well as the scoring criteria. 103.26 specific to bond projects. So it's just outlines all of the requirements, the conditions of the reservations, and so forth. And then 103.27 applies to both 9% and tax credits, and it outlines all of our requirements as it relates to financial feasibility, underwriting standards, very detailed section. But yeah, so that's a quick breakdown. And then 103.35 is fees and performance deposit. So that outlines all the fees associated with submitting an application. If you get awarded, what fees you have to pay, performance deposit, and then also once you've placed the project in service, you have to submit a monitoring fee, which is calculated based on the number of units, and that's all outlined in that section as well.
Yeah, I'll just add, we've included this slide because it's, we'll often get panicked emails from a client. Oh my gosh, we don't seem to be meeting this requirement in the TCAT guidelines. And I'll have to ask, okay, deep breath. We're talking about a 4% project. Are you reading something in 10.326 or is this in 10.325? And it's a requirement that they don't have to meet. So it's really helpful to know where you are in the regs. And of course, sections cross-reference each other, but yeah.
And there's a lot of material in the regulations. And I think as you go through them, it's probably helpful to look at the application and the checklist associated with the application, because it kind of gives it some context, and we try to put all of the regulation citations within the checklist so you can kind of cross-reference the sections, and it'll just make more sense to review them together. Yeah, and then, yeah, so moving on to the next slide. So the next slide is threshold requirements is specific to all applications. Every project that submits an application has to provide these requirements and this documentation in order to be eligible for tax credits. So the first one is site control, and there's a number of different items, but we're just kind of giving high level focused on some common ones. Site control. So this is just, we want to make sure that the applicant has control of the site, that they've either already taken over the site or they're in a purchase and sales agreement with the seller. And there's numerous documents that go along with that. So such as the agreement, sometimes there's extensions to the agreement. And we just want to make sure that the closing date for those agreements goes beyond our application filing date to ensure that, as of the application filing date, you're still in a pending contract and you will close soon thereafter. You are also required to provide a title report. And in the instance where you're in a contract with the seller, we want to make sure that the seller is the entity that holds fee title on that site. So something connecting the seller to the applicant. In the case of where you already own the project, we would expect to see a grant deed. There's other options that are listed under that site control section, but those are the most common ones. Local approvals and zoning. We want to make sure that the site for the project is zoned for its intended use. That all of the discretionary approvals have been met before the application filing deadline. And then development team experience. So development team's made up of a number of different entities. That includes an architect, contractor. Well, the contractor is still sometimes not known actually, but an attorney, tax professional, property management company. All of these team members should be already squared away and on board, and they're part of the development team. So we require information on those entities be provided. The minimum, we have a set minimum construction standards for every project. So that means, and I'll give you some examples. Roofing, there's specific standards related to roofing, exterior doors. We have requirements for accessibility. It's a laundry list. There's at least 10 items probably. And then we also have a requirement for on-site management unit for each project. So that's all listed there. Every project has to meet those standards. Housing need and demand. This is the market study. We want to make sure that the project will succeed where it's located. Obviously, in the more dense cities, you know, it's probably not as big of an issue. It's those remote rural areas that we want to make sure that those have the demand for the project in those areas. We have specific requirements actually outlined in another section, 1032, I think it's 10325. Well, 10325 and 10326, but that where you have to show that the rents that are being proposed at the project are at least 10% below comps, comparables. So that this is where a market study is provided. And so we just want to make sure that there is demand in those areas. And then finally, financial feasibility 10327. So this is just it's a really long section, but it does outline things like developer fee limits, construction profit overhead, which I think are in some of the later slides, cash flow requirements, things like that. So that whole section outlines all of those items. All right, and so as I mentioned, developer fee. So the developer fee has different limits, and just so you guys know, we have a definition for developer fee in the application. And this is basically what the developer is going to get paid for developing the project. As you can see by this chart, there's a variation on the limit each developer can receive. So for 9% new construction, it's the lesser of 2.2 million or 15% of basis. And again, new construction doesn't have acquisition basis, so it's strictly the construction related basis. So if you have a project, I guess a more expensive project, that's not going to get you any more developer fee than say one that would generate 2.2 using a 15% multiplying factor. So whatever your basis is, we're going to multiply that times 15%, and the lesser of that 15% figure and the 2.2 will be the absolute limit on which you could access a developer fee. So that's the most developer fee you can get. Acquisition rehab 9% projects, same drop dollar amount cap. It's again 15% construction related and 5% acquisition. So whichever is more between that sum and the 2.2, whichever's less, sorry, the lower number is going to be the cap. And then 4%, we have different requirements there. 15% of basis. You can see it's a bigger number. There's some notes there, and I'll just go through the left side of that column first. So it's 15% of basis on new construction because there's no acquisition basis. 4% ac rehab. It's 5% acquisition and 15% construction related basis. However, the 5% can be increased to 15%. So this is unlike the 9%. The 9% is 5 and 15. The 4% can be 15 and 15 if the project is at risk. And essentially at risk is at risk of losing affordability. So think a project that's losing a federal subsidy that kept the project affordable and they were at risk of losing that, which would result in the project, say, going to market rate. So that's at risk. A project that's proposing at least 50,000 per unit in hard costs, construction costs, or a project that's restricting at least 30% of their units at or below 50% of area median income. If you meet any one of those three items, you can access the 15% on the acquisition basis. So obviously more higher percentage results in a higher developer fee. The notes on the right-hand side, the 2.5 is the cap. So you see the 2.2 as the cap on the 9%, 2.5 is the cap on the 4%. However, in the interest of incentivizing units and for new construction projects, we wanted to incentivize more units. So we said, okay, for every project that has more than 100 units, you get 20,000 per unit for every unit over 100. And what that would do is it would just add to that 2.55 figure. So that's the cash out, if you will, developer fee figure. And so you could actually get a higher developer fee. You can get 5 million in developer fee, but you have to defer the amount beyond this 2.5 plus the 20K. So say the 2.5 plus the 20K per unit equated to about 3 million, then the 3 million, anything beyond 3 million would have to be deferred. And that was mainly put into place so that projects could access the equity, or not the equity, the basis for that higher developer fee. Because on the 4% side, there's no limit on the federal tax credit. So we're like, okay, yeah, you can get more basis. You just can't take the cash right there and there. It has to be deferred. So anything beyond the 3 million has to be deferred and paid back through project cash flow. So I might be getting too far in the weeds on there, but I'll leave it at that. And then there's bigger limits for projects. We have a pool for BIPOC projects, and they can access a higher amount of developer fee when they joint venture. So going to the next slide, construction contract limits. So as I mentioned before, we have a cap of 14%. That includes general requirements, overhead, profit. So the sum of those three cannot exceed 14%. And that's all outlined in the regulations on what's included in each of those. Capitalized operating reserve. We require that the project during development fund a capitalized operating reserve. So we're requiring that you are capitalizing based on the annual debt service and based on the operating expenses. We're requiring that you have a funding source, which could be tax credit equity, that pays for this reserve in the event that it's needed. Okay, underwriting criteria. So while we understand projects review their cash flow and they have their own underwriting, but as far as when we review the applications, we're assuming through the 15-year cash flow period, because right now our regulations require that a project maintains positive cash flow for the first 15 years. We use assumptions, and we use 2.5 increase of income year to year, 3.5 increase for expenses over a year, and then 2% for property taxes. So if you go to our application and you look at our cash flow, you'll see that those numbers are built into the cash flow. So those are the assumptions that we're using. Vacancy rates for special needs projects, we have 10%. And those are projects that don't have a project-based rental subsidy. And the thought is that, these projects, they don't have rental subsidies, so it might be a little bit more challenging to keep, those projects fully occupied. And so that's why we have 10% there, and then the 5 to 10% for special needs with the project-based subsidy. And then all other projects, we assume a 5% vacancy. So 5% of the income, we're gonna assume at any one point, there's gonna be a vacancy of 5%. Minimum operating expenses. So we don't know how much projects cost to operate exactly, well, at least each project. So we, I'd say years ago, we took our own data for projects. They have to submit what we call an annual owner's expense report and annual owner certification to us, showing what their expenses are. And from that data through the years, we have updated our chart, which you'll see on the next slide. It breaks it out by region, and it breaks that out if the project has an elevator versus if it doesn't have an elevator. And then also by the type of a project, housing type, whether it's a large family, senior, or special needs project. And these are based off, again, off of our own data, and these are just minimum figures. So what we're saying is in the application, the expenses per unit have to be at least these dollar amounts for purposes of us reviewing it for cash flow. And we understand that there are some instances where, I think of rehab projects, we get this where, folks say, hey, we've been operating this project for years. These numbers are too high and we can operate it. We do have an exception in the regulations that allows for projects to go 15% below the minimums, but they do have to provide a letter from the permanent lender as well as their tax credit equity provider. So that's just for underwriting purposes. All right, property tax. So we underwrite with a 1% replacement value. Now, most projects, a lot of projects joint venture with a nonprofit entity, in which case they can get a welfare tax exemption. So a lot of the times in the application, this figure is very minimal because they do have a nonprofit in the ownership structure. Annual replacement reserve. So we want to make sure these projects during the full term of the project have funds to fix the project, replace, make repairs, replacements of different various items, so that we require $250 per unit per year for new construction projects and senior projects, and then $300 per unit per year for all others. So if you look at the cash flow, there's going to be a line item that says replacement reserves. It's essentially saying we're going to pull some of your income and put it into this replacement reserve account, so that as it goes year to year, it'll build a balance in there, and ultimately you can use it for repairs or replacing the roof or something like that. So the loan terms, we have debt coverage ratio requirements of 1.15 to 1. So in other words, we want to make sure that the project is generating enough cash flow that dollar amount is at least 1.15 of the debt service that the project's going to owe. So think, and this is like hard, when we talk about debt service, we're talking hard loans with a hard payment that has to be made. And we just want to make sure that the projects have enough cushion to make the payment and then still operate in a positive cash flow. So there are some exceptions, as you can see, if it's a HUD project or USDA. And then, so that's just the minimum. So we have a minimum in the first 3 years of operations, and then we also have a maximum. So while we want a project to not cut it too close on their cash flow, we want to make sure that the project isn't too rich in that they couldn't have absorbed additional debt if needed. So in the first 3 years, we look at the cash flow, and we want to make sure that the cash flow is below the higher of 25% of the debt service payment or 8% of the gross income. So in the first 3 years, we look at each year and we determine, okay, the higher of the two is an X amount of dollar amount based on these calculations. And we want to make sure that the project does not go over these amounts for the first 3 years. There are instances where we have projects where their cash flow kind of decreases each year. And sometimes a project has to exceed that limit in order to break, as we call break even in year 15. And so in those instances, there is an exception to the cash flow limit in the first 3 years, provided that in year 15, the cash flow is below 2% of the gross income or the lesser of $25,000 or $500 a unit. So it's kind of establishing a number in which if it's less than that number in year 15, then in the first 3 years, there's an exception to those, the 25 and 8% listed there. 9%, yes. So we used to review the cash flow both at every stage, actually, the initial application and then the readiness review. And some projects require what we call a subsidy layering review. These are projects that have rental assistance. We are mandated at the federal level to complete 3 feasibility reviews for 9% projects. So in the instance of where we do a subsidy layering review, that essentially will serve as the 3rd review, and then therefore we don't need to review the cash flow at the place in service stage. So that in years historically we would review it at all stages, but we made a change to the regulations a couple of years ago to not require that in an effort to expedite the issuance of the tax forms at the tail end. So, okay, so going back to the cash flow too, you know, we understand that some projects have a residential piece and they have a commercial piece, and we want to make sure that the project is meeting all of our cash flow requirements with the residential piece independent of the commercial piece. So in other words, if the project's not making enough income and they're relying on the income from the commercial piece, what we're saying is that's not allowed, and that they have to have separate cash flows to ensure that the residential piece is feasible through the 15 years, independent of the commercial piece. All right, we have a poll question. Okay, so TCAC's poll question number 6, TCAC's underwriting requirements apply to 9% projects, true or false? We'll give you a maybe 10 seconds. About half the responses so far. Right, I think. Okay. All right, so we got 93% of you chose false, and that is correct.
Yeah, just wanted to reiterate for folks that all of the stuff that Anthony just covered, that applies to both 4% and 9% tax credit applications. But now we're shifting to this next section that is specifically about 9%.
Thank you, Sharon. All right, okay, so the 9% application. 9% projects are competitive, as we've drilled in. There is a scoring criteria. There's also additional threshold requirements. And I think Sharon had mentioned that some people ask like, hey, which things, you know, which requirements are on a 4%, or they're asking a question about, and I think one of the main ones that comes up is the additional threshold requirements, because there's square footage requirements and things like that. in those. And we get questions on the 4%, and we're basically like, nope, that only applies to the 9%. So you guys don't need to worry about the square footages. Also, this point scoring system, there's probably like, I think, nine or 10 different categories, multiple tiebreakers, some of which are specific to a couple of jurisdictions. And then we have a tiebreaker calculation that incentivizes soft loans and public money. And then also we have a specific allocation system where we go through set-asides in the regions. And I probably could talk in hours about that, but I don't think I have that time. So I'm happy to, if you ever have questions, feel free to reach out, and I'm happy to go through, walk anyone through that. So, okay, so I'm going to move on to the next slide. 9% projects require that deferred payment financing grants and subsidies all be committed. So these are soft loans, loans from public entities. We require that those all be committed at the time of application. We have project size limits. Rural projects, we cap those at 80 units. We used to have a cap on the new constructions, but when we switched to more emphasis on units, we said, hey, if you can justify it in the demand that you can build more units, then that's why we removed the cap. We wanted to encourage it. And then rehab projects, sometimes there's restrictions on some of the changes that can be made to these rehab projects. So we have no limit on those. And then we also have some options where if there's projects, there are these Hope 6 projects, which I don't think we ever see waivers for these because we never get requests for them, but there are other avenues to go around the limit, but they're very narrow. I think this was mentioned earlier too, the hard cost per unit, 40,000 is the minimum for a 9% project, or 20% of the adjusted basis of the building, whichever is higher. That's typically the 40,000. The next slide goes into the housing types. So as a 9% project, one of these housing types has to be selected and all of the requirements have to be met. So if you want to apply for 9% credits, it has to meet one of these 5 housing types. And I think I touched on the at-risk a little bit, but basically these are projects that had either a federal subsidy or something that had the units restricted, and then those are at risk essentially of being going away, if you will, and these projects could potentially go market rate, which would be, obviously the existing tenants wouldn't be able to pay those rents, so it would be very difficult for that project. So that's why we have housing type for at risk. Large family projects, we have different, we require 25% 3-bedroom in those, and then also 25% 2-bedroom. We have minimum square footages requirements. We have outdoor play area requirements, common area square footage requirements, and then pretty much all of the housing types have also laundry, washer and dryer requirements based on the number of units. And then moving on to senior, all the units have to be restricted to seniors. And each one of these housing types has about 10 different requirements. Some of them overlap. Special needs, at least 45% of the units have to be special needs. And if it's less than, and sometimes we'll get projects that are 100% special needs, but we do require that if the percentage is less than 75%, you have to meet a different housing type, or it's specifically outlined within that section. And then special needs and SROs, they both have to have an average of the units, the AMI restricted at or below 40% of area median income. SROs, at least 90% have to be SRO units. And we had it where SROs kind of went away and then they came back, but we don't typically see too many of those projects. But again, I just want to reiterate, if you're applying for 9% credits, one of these housing types has to be selected and all of the requirements have to be met. And I think I touched on some of this already, so I'll skip to the next slide. Okay, so the point system. So the housing types, while I said they were a threshold, they're essentially a point category also. So if you look at this chart here, housing needs is listed under there as B, and that's basically you just meet a housing type. So every project in the 9% system has to get this 10 points because that's a threshold requirement, an additional threshold requirement. But some of the other categories that we have are experience, and it's both general partner experience as well as management company experience. So we want to make sure that the developer and the management company have experience with these type of projects. A few years ago, we added a requirement that both the GP and the management demonstrate that they have specific tax credits, California tax credit experience, because it's not unusual that we see projects that have HUD projects and projects from other states, but we just want to make sure that you have at least 2 projects in California. Housing needs, I think already discussed. Site amenities, so this is proximity to different amenities, and this could include hospitals, grocery stores, libraries, public parks. And we also have a couple of other options. If you're in a high or highest resource area, you can get some points there. The limit in that category is 15 points. So even if you have more points than 15, we're going to cap you at 15 for purposes of the scoring criteria. And also I'll give you some background. It's very unusual that we award projects that don't have full points. So if you apply in the 9% competition, you, for the most part, have to get full points to be competitive. Okay, and then moving on to C2 is the service amenities. So that's a 10-point category, and you can, these are resident services being provided at the property. You get points for demonstrating that. And then lowest income, that is made up of a table that we have in the regulations. It's basically however many units you have percentage-wise restricted at specific AMI levels. We do require that at least 10% be restricted at or below 30% of area median income in order to get the full points. Those again have to be spread out among the bedroom sizes as previously mentioned. We have readiness to proceed category. So that's a 10-point category. You have to have all of your construction financing committed. And then also you have to close your construction financing. So if you're awarded, you have to close within 180 or 194 days, whichever date you're assigned. And there's a laundry list of documents that need to be submitted to confirm that you have closed construction at that point. And then finally, the miscellaneous federal and state policies. It's a 2-point category. It's kind of like there's a number of different options there, and it was basically options that didn't fit under any other point category. So we have them as a separate category. It's only 2 points. You can get it in a various number of ways. The most common one is accepting a federal state credit exchange, which is 2 points. So basically you just are agreeing, if needed by the end of the year, if you have to exchange some of our credits, you know, we will be willing to accept that. So it's a total of 109 points. We do have a minimum figure that you have to score in order to be successful. I think it's 85% of that number. I don't have it in front of me right now, but we do have a memo on our website and I think it's outlined in the application. Okay, so the tiebreakers. So I think I mentioned earlier in LA and San Francisco, if you have a formal letter, because these are two geographic regions that only have essentially one jurisdiction, single jurisdiction region. If you have a letter of support from either the San Francisco Mayor's Office of Housing in San Francisco or LAHD in the city of LA, you can get a tiebreaker. And this is only in the region competition. This is not in the set-asides. So that will essentially give you a bump up over another project that does not have this letter of support. And then the first tiebreaker, which is the housing type. We have housing type goals, and I'll just give you an example. Large family is 65%, special needs is 30%. We have these housing type goals, and this tiebreaker is meant to try to advance us to those goals. So anytime we have identical projects competing against one another, if they have the same point score, we're going to look at their tiebreaker. And the first tiebreaker outside of the LA and San Francisco is the housing type. So if we've met our goal at the time that we get to these projects, so say we have a senior project competing with a large family project, if we've met the goal for the senior, all things equal, we're going to select the large family project, and vice versa. And in the instance that we haven't met either goal, or that we've met both goals, then we'll go to the second tiebreaker, which is the sum of the two ratios that you see on the slide, which is, again, it incentivizes public funds and soft financing that could be in the form of a loan or even donated land. So if a local agency donates land to a developer, the value of that land, as verified by an appraisal, can get you a competitive advantage in the tiebreaker. So there's two ratios. It's that figure over the total residential cost, and that's added to the one minus, okay, the unadjusted eligible basis. So the unadjusted eligible basis is your requested basis. So in order to be even more competitive, you can choose to reduce your basis from what you would otherwise be eligible. So therefore you're getting more, or you're getting fewer credits than you probably could have gotten. If you do that, that'll also make the project more competitive. And then there's other things in the tiebreaker that I'm not gonna go into, but it incentivizes units, more units. There's that size factor, I don't know if you see in the first ratio, that will help your score. And then also if you're in a high resource or highest resource area in the opportunity map, the TCAC ACD opportunity map, that'll also benefit your score. So the tiebreaker is it's evolved through the years, but we're constantly looking at it to simplify it, but it's a little challenging because right now we're trying to get to some public policy goals, so always up for review. And the slide 117 is showing a sample of the tiebreaker sheet that's within the application. So you fill in all of the yellow fields and it essentially will calculate your tiebreaker. And then when we review it internally, obviously we do our own review and make sure that the score is that we get is the same score that you guys have scored.
Yeah, and I'll just add another aspect to sort of this leverage soft financing. If you have project-based vouchers or any other sort of rent or operating subsidy, the value of that subsidy is also included in the public funds. And even though it's the sum of these two ratios, the first one is really more of the driving factor. So yeah. Dollar per dollar, an additional dollar in public funds will help your tiebreaker a lot more than decreasing your costs or decreasing your eligible basis.
Thank you. Okay, so the 9% credits, the allocation system, I think we barely touched on it, but it's broken out with the set-asides and the geographic regions. Set-asides are made up of nonprofit, rural, special needs, and at risk. So there's specific percentages that you can see on there. I've got to zoom mine in a little bit. It's 10% for nonprofit, 20% for rural, 4% for special needs, and then 5% for at risk. Supplemental is just put there in the event that we go too far over that that credit is to cover any overages. And the funding order, and when I say, and it's important because the way that the credits are taken are they're split up with these percentages, and then the remainder of the credits goes to the geographic regions. And the geographic regions make up about 50-something%. And those are combined with state tax credits to determine how much is available in the geographic regions. So I'm not going to go there yet. But the funding order starts in the nonprofit, and there's a preemptive priority in that set aside for homeless assistance projects. So I'd say primarily any project awarded from that nonprofit set aside is usually a homeless project. And I'd say we typically fund 2 to 3 in a given round. Rural is the next section that we fund, and then at risk, and then special needs. And that kind of covers all of the set asides. And then we go into the geographic regions. And there's some notes there. The projects that apply in the nonprofit special needs are at risk. If they're unsuccessful in the, in those set asides, they drop down into their geographic regions, which allows them a second chance to be selected for an award. Yeah, and then rural projects, they can only compete in the rural set aside, so they don't have the same, they can't drop down into a region because they're either rural or they're not, and we have a methodology outlined on our website that kind of helps an applicant determine if they're rural or not. Okay, 119, slide 119, the allocation system. So we showed those percentages for the set asides. These are the percentages for the geographic apportionments. So projects are competing within their region only, with exception of the set asides. And as you can see, the city of LA and the balance of LA have the bulk of the credits. And yeah, so any overages, we have specific rules in the funding order as far as how far over we'll go in a given region as it relates to the amount of credit. So the credit gets divvied out by these percentages, and that's what's available in a given round in those regions. And then the projects that apply are put in those regions, and then they compete within the regions. Okay. And then the housing type goals I kind of touched on earlier. These are just the goals that we have outlined in the regulations. And again, this is the first tiebreaker too. So, and don't try, they will not add up to 100. They're just kind of essentially soft caps. So the minute we hit 65% for large family, then another project competing with the large family with the same score would benefit if their goal hasn't been met. So, all right. So I think that's it. And I think we have another exercise for you all.
That's right. Thanks so much, Anthony. Appreciate it. All right, so this next exercise, this will help you sort of think about all of the stuff that Anthony just covered. It's called Harupa Village. And the way this is going to work, again, we'll break out into breakout rooms. But what you'll be provided is an exercise scenario. And your job here is to identify all the ways in which this imaginary 9% project does not meet the threshold requirements, TCAC's underwriting requirements, where they might make errors in calculating the tax credits, and where they might not do so well in the scoring or tiebreaker areas. Right. So read through the scenario here. A lot of the answers are just in the text before you even get to the numbers. All right. So you'll get this scenario. We give you some backup information from the TCAC regs about affordability and operating expenses. And then you also get a very bad pro forma. So this pro forma also has a lot of errors as relates to the underwriting and the cash flow. So pick out mistakes there. And we're gonna give you about a half hour in the breakout rooms to work on this. And I would recommend that you take 15 to 20 minutes to work on it yourself and find as many errors as possible, and then spend the last 10 to 15 minutes of everybody in the group sharing your answers. A lot of the information is in the slide deck that we just covered, so you can look back there. You probably don't have to open the TCAC regs, but if you want to, you can. And I'll just say this is a bit of a stretch exercise, particularly if you have never completed a 9% application or had to wade through the regs. But done this with lots of groups of people, and with everybody thinking together, every group usually gets most of the answers. All right. So then we'll come back to the main room in about half an hour and share our answers. So Martin, can we open those breakout rooms, please?
Of course, here we go.
Thanks. Ooh, actually, Anthony, before you leave, if you have an answer about this, to this question, how can LIHTC non-compliance be reported and how would it be investigated or enforced? I don't know much about compliance.
Well, is it more just, well, obviously non-compliance is reported through our, are they talking about reported, they're talking about reported to TCAC, not us reporting it to the IRS. So
That's right.
I would just say if there's, something, just contact us. There's no, I don't think there's a set way, obviously if, I don't know if this is a resident or a management company or something like that, who's reporting this.
Mhm.
Because I mean, I can't imagine it would be the owner or the management company. So I would assume maybe a resident would, in which case we get a lot of resident calls.
Mhm.
We have a designated staff that addresses those and make sure, it's a TCAC project, and we do look into it, and sometimes follow up with the owner depending on what the offense is. Sometimes it's out of our jurisdiction and it's not a non-compliance issue for purposes of what we would be reporting them as. But I would say just email us. I would say Quang Lee, and I could put. You want me to put that in the chat, or do you want to do it?
Yeah, I'll put it in the chat.
So Quang Lee, and it's Quangle is his last name, and I would say just reach out to him. His email, his contact information is on the site.
Okay. And do you know, are there?
And as far as, oh, sorry, go ahead.
No, go ahead.
I was going to say, as far as the how would it be investigated, he'll look into it. He'll check in with the owner if necessary. Like if it's stuff that he can find out without going to the owner, he can do that, obviously. But if he needs to talk to the owner, he'll have to talk to the owner. And then remedies, if they're still within their federal compliance period and they don't meet a compliance requirement, we could follow 8823, which is the form of we could file that. If it's outside of that, we could issue a fine, or we can issue negative points. It really depends on what it is and what point it is, what point stage the project is in.
Got it. Okay, thanks.
Uh-huh. Sharon, you guys are going till 5, right?
Yes, we are.
Okay. How are you guys? I think I might have ran a little over, sorry.
It's okay. We'll catch up. We always
Okay.
know that the section after this usually loses a few minutes, so it's all good.
Yeah. Okay.
All right. Is everybody back? I think so. No, not really. Unless we lost a lot of people towards the end of the day. That might be what happened. Oh well. Yep. Yeah, I think so. Well, thank you to those of you who stuck it out. I was hoping we could take some time in this room. I'll acknowledge this exercise is a tricky one. But if folks wouldn't mind chiming in, what errors did you find? Let's talk through it, and then we'll post the answer sheet to the Dropbox link in the chat also. So go ahead and take yourselves off mute and holler out some errors that you found here.
No site control.
That's
or
right.
zoning?
Yeah, they only have a 3-month purchase option, and the application is due beyond that window, correct?
Minimum experience.
That's right. What gave you the hint on the minimum experience?
I think it said it was their first project.
That's right. They have no completed rental projects.
Let me ask you a quick thing about that though. Although it says it's their first, could it be implied, or well, could they still substantiate in their application that they're working with contractors or consultants that have experience as opposed to them themselves?
So the way that a general partner would apply without having their own experience would be to partner with another general partner.
That's okay.
So joint ventures of that nature, you can then gain sort of experience for yourself, but rely on the other general partner's experience for the points.
So in contrast, just to kind of beat a dead horse, as a general contractor, if you have standby contractors you work with on a regular basis that has experience, can you make them part of your app, or can you not do that if they're not permanent staff?
Oh, you can use, I don't think there are, so there's no scoring related to general contractor experience. And I don't think there is like a requirement that your GCs have a certain level of experience.
Okay, thanks.
Yeah. All right, anybody else?
No, that's correct.
Yeah. I know Tina in group 5 was finding some stuff.
Location, and their DCR is at like 1.4.
Right, so they do exceed the cash flow in the first 3 years. What about their location?
I think it's in an area that's not deemed high. It's not like in an area in San Diego County that is sought after. So I think that's what I kind of see as it being a location being an issue.
Got it. Yeah, I don't think the case has enough information about the location to know how it would score on site amenities, for example.
Yeah.
And not being in a high or highest resource area, might hurt certain things, but it would not prevent them from moving forward.
But they made a mistake on the basis calculation. As a result, they used the 130%.
That's right.
That they
Yes.
shouldn't have done.
Yes. So we're told in the case that they're not in a small area, an SADDA or a QCT, but they did take that 130% boost erroneously. Correct.
And then they also did they included the wrong number for the developer fee in the eligible basis
Yes.
calculation, where they realized that it should have been 2.2 million, but they put the 2.7 million in the basis calculation.
Right, yeah, their total developer fee is in excess of the limits, their developer fee and basis. All right. Anything else?
Some of their pro forma assumptions didn't meet the requirements, like the escalator was not the expense escalator of 3.5%, and the vacancy rate didn't meet the minimum requirement. I also suspected that the expenses per unit were too low, though I wasn't able to cross-check that exactly.
Yes. Yes, the operating expenses were too low, and you are correct on the vacancy and the operating expense being incorrect. Vacancy should have been 5%.
And I'm cheating on this because Janice told me the answer, but there's a 2.5 million a year cap in the annual tax credits that was not acknowledged here, and the fact that they calculated them wrong and they weren't entitled to the 2.5 million regardless would have fixed it, I suppose, but it was hiding in plain sight right there.
Yep, that's right. And the last error in the tax credit calculation is that they were calculating from the eligible basis, or sorry, they were calculating from the threshold basis limit. In this case, though, the eligible basis was less than the TBL, so they should have calculated it from there. All right, so there are a couple like big picture threshold requirements and points requirements that I just want to be sure we talk about real quick. Anybody catch any of those?
Well, he really didn't have any experience in like multifamily housing.
Yep, that's right.
And then he also put in there that he runs a daycare, but I don't know if he was trying to throw that in to support supportive service housing, but
the daycare
I don't know how he was trying to tie that in there if he really didn't have any experience with the multifamily housing, with supportive housing.
Sure. Yeah. No, the daycare, that's just like extra case information, but really the fact that they haven't done any rental housing is the big issue here. All right. Anybody else?
And then also, I did put down, the bank is also the sponsor for the committed affordable housing program loan. Is that a conflict of interest?
No, not at all. Often the construction lender will be your sponsor for an AHP loan. But there was an issue with the construction loan. I know I heard it mentioned in group 5.
Yeah, I think the description showed that they received 16.2, but then the pro forma showed like 20.2.
Yep, that's right. Yeah, the construction loan, they didn't have the full construction loan amount committed. They also don't have the city's home funds committed because that won't be awarded until after this application. So big, like the starting point, this one doesn't meet a housing type. It doesn't meet the threshold for large family developments because it doesn't have enough 3-bedroom units. You need at least 25% of your units as 3 bedrooms. And then the other things are they won't maximize their affordability points. So you need 10% of your units at 30% AMI. And with this one, not having the construction financing committed and discretionary zoning approvals pending, they will not be able to receive full readiness points, right? And at the end of the day, even if they were able to fix all of these other things, their tiebreaker is very weak. They will not, they have limited public funds, and their tiebreaker would not do so well. All right, so we will post these answers to the Dropbox and to the chat here. And let me pick back up with the presentation here. There we are. All right, and I'll pass it off to Chad to finish up our day with a speed through of our timelines here.
Cool. So I'll just run through timelines and fees very quickly. First, for the 9% tax credit timeline, we're looking at putting in an application. These happen twice a year, typically early spring and then mid-year around July. After that, if you're successful, you'll get our preliminary reservation letter that's gonna say, hey, you're successful. Here are the core dates that you need to keep in mind. And we always recommend pulling those dates out, probably putting them on a spreadsheet or putting them into your calendar, because a lot of these dates are firm. One is submitting the carryover application and the 10% test if you elect to do it. With the carryover application, there's option to defer the 10% test by a year by a year of receiving the carryover. But basically, we put in the carryover application in order to extend the place in service deadline so that you have until the second year after receiving a tax credit allocation in which to place the project in service, which basically means receive TCO on at least one unit at a minimum, preferably, and your investor may require you either to TCO or CFO beyond that. Your readiness closing deadline is going to be established within your reservation letter. Typically, well, it's either 180 or 194 days, and projects within a given round, basically it's split in half. Half of them get the 180-day deadline to close, and the other half get the 194-day deadline to close. We recommend looking at your reservation letter, figuring out which one you have. You don't want to accidentally think you have the 194 deadline and work toward a closing date that's later than what you actually have. As I mentioned earlier, the place in service deadline is the second year following the preliminary reservation and carryover allocation, and you need to complete at least one unit by the end of that second year. And within a year of achieving place in service, then you have to submit the 8609 or a place in service application to TCAC. TCAC has an extensive checklist on their website. I definitely recommend looking at it. It will cover everything you need to submit. And then we went through a bit of this earlier, but competitive applications for the 9% project, and of which there are 2 rounds a year, and typically awards are made 2 to 3 months after application. And after receiving your preliminary reservation, then you have to submit the performance deposit, which we show on the next slide. And that performance deposit is returned once you put in the place in service package. And once that's approved, the monitoring fees at the bottom, which are $410 per restricted unit, are deducted from your performance deposit total and returned to the sponsor. So here's a sample calendar. I recommend looking at it just to get a rough understanding of how this timeline stacks up with real dates attached to it. One thing that I do want to point out is, let's see, this is based on a round 1 application, but knowing that there are 2 application rounds a year for competitive tax credits, if you submitted a round 2 application, I just want to point out that the place in service deadline is the same. So if you have a project that requires a long time to construct, just always keep in mind that you're held to the same place in service deadline, and therefore maybe you're only able to apply in round 1 for competitive tax credits. Otherwise, you wouldn't be able to hit that deadline. So in terms of fees for a 9% credit application, you have the application fee of $2,000. There's also $1,000 for the local reviewing agency. That's typically in the city or jurisdiction within which you're located. That fee, you can request that the local reviewing agency waive it. Some of them really don't count on the fee. So that's just an extra tidbit that you can always access with that. Then there's the allocation fee of 4% of the annual federal credits, and given that federal credits, you max out at $2.5 million a year. That fee maxes out at $100,000. The performance deposit for competitive credits is 4%, and then the monitoring fee is $410 per unit. The allocation and performance deposit you pay after receiving your reservation and before starting construction. For the 4% tax credit timeline, you'll see that this has a lot less arrows than what we were looking at on the 9% side. And that's partially because you don't have the firm place in service dates that are established with the federal guidelines. So there's usually 2 to 3 application rounds per year, the same 90 days to score and review. And then tied to the bond regulations, you have 6 months within which to close the project, so 180 days. The only other timeline piece to keep in mind is similar to the 9% application. Within a year of achieving place in service, you have to submit the 8609. So for joint applications, you're submitting jointly to TCAC and CIDLAC. They're 2 separate agencies. There are different requirements that come into play tied to each of their regulations. I definitely recommend looking at both of them. If you've only submitted 9% applications, you may think that, oh, you know everything already and don't need to look at the CIDLAC at the bond regs. Definitely look at the bond regs and vice versa. The TCAC and CIDLAC schedules are posted at the beginning of the year, so it's good to take a look at them and know in advance, and we'll touch on this in a couple of slides, when applications are. That way you can prep a lot of time. For bonds, if you go back 1 slide quickly, just want to point out no carryover requirement given that you don't have the firm place in service deadline. So an example of fees, this breaks out the fees to TCAC and the fees to CIDLAC. You'll have to cut fees to 2 separate entities, so keep that in mind. And also just note the differences in fees, particularly around the performance deposit.
Great. I think we're gonna just close it out here. There are a few more slides at the very end here that just sort of get at the point that there's a lot of planning that needs to go into these applications, and it's sometimes a multi-year process to get there. But hopefully everyone now feels a little bit more informed about the tax credit program in California in particular. And the 9%. So don't want to hold folks too late, but do want to say thank you so much for joining us today. Thank you, Janice and Chad and Anthony, for being here. If there are further questions, feel free to pop them in the chat. We'll answer a few more as we stick around, or if you want to ask them out loud now, that'll be fine. And yeah, hope you have a great rest of the conference.
Thank you.
What happens if you don't make the 180 days?
May I? No. Right now, right now the regulations does, it says that we would either rescind your credits or you will be assessed negative points. And we left it like that for a reason, at least before, I think it was a full rescission of credits automatic. But we wanted some sanctions to be put in place in the event that that deadline was not met. So right now we have that. I think at the last meeting they adopted some exception for USDA projects, but like it's a very narrow. Like I would definitely suggest looking at the regulations because there's not too many exceptions. And yeah, and I would say typically, I don't want to say never, but like typically we probably would issue negative points unless we felt that there was something that the applicant didn't do that they should have done, because most of the times it's out of the applicant's control. We also are cognizant of the federal place in service deadline. So if it's something that's going to push the construction start date too far back to the point that it's going to put the federal place in service deadline at risk, then we might choose to rescind the credits in those instances, since, you know, and it can vary from project to project. Obviously, rehab projects can be completed quicker, so maybe that time frame isn't as urgent. But like, say, a high-rise project or some project that has a very long development timetable, construction phase, we would consider rescinding the credits on those projects.
Yeah, and it should be noted that missing that federal place in service deadline, that's a cliff event. That's you lose your credits. That doesn't.
And at that point, you've already put in all your, you've put in the construction's done, you know, anyway, so.
Thank you. What happens if it's like a two-phase project where like the first phase, you know, makes the deadline, and then for some reason there's like delays, and the second phase moves forward, and then all that, like it's a trickle effect. So.
Well, I'd say if they're separate applications and were at different meetings, or are you asking if we would rescind the credits in those instances?
Yeah.
Well, I mean, if we're treating those place and service deadlines independent of one another, if they're phased projects, each project or phase is going to be held to their place and service deadline. So I think we'd have to see what, there's no clear cut answer. We'd have to see what the situation is. But I will say the project would get, at a minimum, they would get negative points. I'll say that.
Thank you.
Mm-hmm.
I actually have some questions that actually weren't covered in the presentation, and maybe or not, you can respond to them. I work with a nonprofit. I'm a board member of Eden Housing. Plus, actually, in my day job, I work with a nonprofit in the city, San Francisco, where we work with clients who are seeking affordable housing opportunities through subsidies. So, on a daily basis, with my background, I know very little about tax credits. I mean, I know a little bit about it. Today was a refresher for me, so I appreciate it. But in the day-to-day operation, I find that some of the property managers I work with at buildings that we partner with, they seem to be very, well, just not really familiar with the concept of applying a tax credit concept. And what I mean by that is sometimes so my question is, what kind of disclosure should there be in a rental application and or lease if you're involved in a tax credit property? Because quite often, I'm familiar with it, but a lot of our clients are shocked to find that there's a rent increase within a year's period after they move into the unit because of tax credit regulations.
Well, Sharon, did you want to say something?
Well, I would just say that I don't think any of us are experts on the compliance and on the property management and end of things. But yeah, I don't know, Anthony, if you have.
I will say that, are you talking about the selection process?
No, I'm talking, for instance, you have a 1-year lease, and you know your lease, there can be no changes in that lease, right? Without a 30-day notice, and you're going to increase your rent annually based on most local jurisdictions and some state affordability legislation. But because of tax credit properties, and the units are already deemed affordable and they're exempt from a lot of local and state ordinances or regs, still a lot of applicants or tenants will find it surprising when they've been in the property less than a year and they get a rent increase because of the tax credit reg. So I'm curious as if you have any experience.
I don't know that it would be because of a tax credit reg.
Well, like annual certification, they're doing their tax credit recertifications, they'll increase their rent parallel to the amount of funds that they can collect from the tenants in order to have that funding consistent with the amount of revenue for that building. Correct? You know, the operating costs, you know, increases from year to year and so forth. So, you know what I mean? So as the year-to-year operation costs increase, and that's passed on to, in part, to the tenant in portion, and then the rest of the portion is through the subsidy. So as an oversimplified example, we may have a client whose market rent is 2,000, they're paying 1,000, we're paying 1,000, but then because of the annual increase through the recertification, now the rent's 2,100, so our client's now paying, you know, half of that increase, and we're paying the other half of the increase, or whatever the proportions allow us, for they're still paying more than 30% of their income. So
Yeah.
does that make
well,
sense? I'm
like
kind of going
Sharon-
off, I'm rambling now.
Well, I maybe we can follow up and have a conversation. Feel free to reach out to me after this.
Sure,
I'd
sure.
probably have to look into this. I don't think I could answer that question. I'd rather look in with staff and
I got
find
you.
the
Okay,
exact scenario that you're just talking about.
sure. Okay, I appreciate it. Thank you.
Yeah, no problem.
Well, thank you all. I'm gonna leave now.
Great.
Thank you.
Alvin, thanks, everybody.
All right.